Hi everyone, today we will be discussing the topic of investment appraisal. This is part of our A2 syllabus and specifically part of the cost and management accounting exam. Okay, so what does investment appraisal talks about? It simply talks about different methods to assess an investment. What does that mean? It gives us an answer that whether it is worthwhile, whether it is beneficial to invest in a project. What does that mean? It simply talks about the returns on an investment. For example, you have two options. For say, you can either expand your factory or you can replace your machinery in the current factory. Now, using the techniques in investment appraisal, you can choose the right project in order to generate the maximum return for your business. Now, there are multiple methods to assess the investments. What are those methods? The first one is called accounting rate of return, which is also known as ARR. Secondly, we have the payback period. Then we have some advanced concepts as well, such as the net present values, the NPV, and lastly we have internal rate of return, also known as IRR. The first two methods, they are comparatively easier and very basic. Let's start with the first one, the accounting rate of return. Okay. The accounting rate of return. This is the most easiest method for assessing an investment. It can simply be calculated using a formula, which is the average profits divided by the average investment, and then you multiply it with 100 in order to calculate a percentage. Now, what does average investment mean and what does average profit mean? Let's try to understand that as well. The average profit simply means the total profit that the investment is going to generate over its life. The life of, we can either say the life of project or the life of investment. Okay. Secondly, we have average investment. Now, what does average investment mean over here? Average investment means simply the initial investment that we are going to be making in the business or in the project. The initial investment, we are going to add the residual value of the investment, and we will simply divide it with 2. The residual investment simply means, we can understand it by using an example. For example, you purchased a machinery for $50,000, and at the end of its useful life you can scrap it off or you can dispose it off for $5,000. So at the end of its life you will be receiving $5,000. That is what the residual value or the scrap value is. So using this simple formula, you can calculate the accounting rate of return. Let's look at an example for it as well. Okay, so over here it says that a company is considering in investing in a project which requires an initial investment in a machine of $40,000. Okay, and then net cash inflows This means that we are going to be receiving this money from the investment. Of $15,000 will be generated for each of the first 2 years. This means that in the year 1 and year 2 each, we will be receiving $15,000. Then $5,000 in each of year 3 and 4. So in the next 2 years, we will be receiving $5,000, and then we will be receiving $35,000 in year 5. Okay, after which time the machine will be sold for $5,000. So at the end of the life of the project, we will scrap that machine. We will receive the residual value of that machine, which is $5,000. Let's try to calculate the accounting rate of return over here. First of all, let's calculate the average profit. Now, one thing that we need to understand over here is that we are given the cash inflows and we have to calculate the profits. So what we are going to do over here is that we will simply take the cash inflow and we will deduct the amount of depreciation from it, so that we can reach the figure of profit. Okay, let's do that. We have year 1, year 2, year 3, year 4 and year 5. Let's write down all of the inflows over here, which are 15,000 in the first 2 years, then in year 3 and year 4 we will receive $5,000, and then in year 5 there is $35,000. Okay, let's calculate the depreciation as well. Depreciation is very simple over here. We will simply calculate the depreciation using a straight line method. So what we will be doing over here, we will take $40,000, we will reduce the scrap value, deduct that, and then divide it with the useful life, which is 5 years. So $35,000 divided by 5. So there is a depreciation of $7,000 each year. Alright, and we will be deducting this depreciation over here. So let's calculate the profit. The profit should be 8,000 in the first 2 years. Then there are losses of 2,000 in year 3 and year 4, and then there is a profit of $28,000 in year 5. Okay, now in order to calculate the average profit, we will simply take total profit and divide it with the life of the project. What is the life of project over here? It is 5 years. And what is the total of all the profits? It is 8,000 plus 8,000 minus 2 plus 28,000. So there is a profit of $40,000, the total profit, and we will divide it with 5. So there is an average profit of $8,000 per year over the life of the project. I hope this part is clear. Moving on, we have to calculate the average investment as well. Let's calculate that as well. Average investment. Now we saw above that average investment can be calculated using the initial investment, adding the residual value and dividing it with 2. Okay, let's do that. So the initial investment was $40,000, then the residual value is $5,000. the residual value is $5,000 and we will divide this number with 2. So we are going to get 45,000 divided by 2, which comes up to $22,500. This is the amount of average investment. Okay, now as we have calculated both the components that we require for calculating the ARR, let's finally calculate the accounting rate of return. So we have an average profit which is of $8,000. We will use this. $8,000, and then we will divide it with the average investment, which was 22,500, and in order to calculate a percentage we will multiply it with 100. So the answer should be 22,500 into 100. This comes up to approximately 35.556%. I hope that you are able to understand how to calculate the accounting rate of return.